Welcome to The Explainer. You know that quiet, sleepy week between Christmas and New Year's? Well, today we're breaking down a fascinating theory that suggests while most of us are relaxing, that exact period could be setting the stage for a major shock in the silver market. So let's dive right in. It all starts with this idea of the ghost week. What is it? Well, it's that 10-day window right after Christmas when things really slow down. For most people, it's nothing special. But for a certain group of traders, it's a time they watch very, very closely.
And here's the core idea in a nutshell. This holiday lull, when trading volume just dries up and all the big players are away from their desks, could create the perfect set of conditions for a sudden, and I mean really sudden, price explosion in silver.
To set the scene, let's say the price of silver is already sitting around $72 an ounce come Christmas Day 2025. Now, that's a pretty high price historically, but according to this theory, that's not the peak. It's the launch pad for what might come next.
Okay, so how could something like this actually happen? Well, it starts with a trigger, and that trigger is an annual event that pretty much drains the market of both buyers and sellers, creating something called a liquidity vacuum.
Let's make market liquidity super simple. Think about a big, bustling supermarket on a Saturday. You can buy or sell pretty much anything without a problem. That's high liquidity. Now picture a tiny corner store at 2 in the morning. Very few people, very little stock. If one person comes in and buys all the milk, poof, the shelf is empty. That's low liquidity, and that's the kind of environment we're talking about here.
And this timeline really lays out that 10-day market blackout. It kicks off with Boxing Day, a major holiday in places like London. Then you roll through a weekend right into New Year's. All the big banks, the hedge funds, they're running on skeleton crews if they're even open at all.
And here is the absolute crux of the argument. While the human traders are on vacation, there are 145,000 futures contracts that are still very much active. These aren't just suggestions, they're legally binding promises to buy physical silver, and that represents billions of dollars in demand that simply does not take a holiday. Now that trigger, the empty market, isn't just happening in isolation. It's being aimed squarely at a market that's already under some serious pressure from a long-term, deep-seated problem. For 7 straight years, the world has consumed more silver than it has managed to mine and produce. This isn't just a blip on the radar. We're talking about a persistent, year-in, year-out trend. And all those years of deficits have created a massive shortfall. Just since 2021, the gap has grown to 678 million ounces. To put that in perspective, that's almost a full year of the entire planet's mining output that has just been, well, drained from global stockpiles to meet demand. This chart just illustrates the problem perfectly. You can see global mine production is basically flat. It's grown less than 1% a year. But at the same time, industrial demand for silver has shot up by 15%, and it's picking up speed. The gap between supply and demand is getting wider and wider. So you have to ask, where is all this demand coming from? Well, the engine that's driving this entire situation is a huge technological shift that's using up silver at a pace that has caught a lot of people by surprise. What's crystal clear when you look at this is that industrial use is now, by far, the biggest piece of the silver demand pie. We're not just talking about jewelry or silverware anymore. Silver has become an absolutely critical component in so much of our modern technology. And a huge part of that industrial demand is the solar industry. In fact, get this, the new, more efficient solar panels called TOPCon panels require a staggering 15% more silver per panel than the older models. Just that one change is like pouring gasoline on the fire of global silver consumption. Hey, just a quick pause here. If you're finding this explainer interesting and want to see more like it would be a huge help if you'd hit that like button and subscribe. That way you won't miss out on any of our future updates. Now, a sudden price shock in an empty market, it might sound like something out of a movie. But we've actually seen this exact mechanism, a liquidity vacuum causing a price explosion, play out before in other major financial markets. I mean, look at this. From major currencies like the Swiss franc, which jumped 30% in just a few minutes, to other critical metals like palladium and lithium that saw these incredible price spikes. History shows us that when intense demand meets an empty market, prices don't just gently rise, they can gap upwards violently. So what's the big takeaway here? It's that this theory isn't about just one thing. It's about a rare collision of several powerful forces, all converging on the silver market at the exact same moment in time. The theory lays out a potential feedback loop. First, liquidity disappears. Then the buyers return and cause an initial price jump. But that jump could then trigger margin calls, forcing anyone who bet against silver to rush in and buy, pushing prices even higher. It becomes a vicious cycle, or what traders call a squeeze. And this table really brings it all home. You've got the holiday blackout, meaning virtually no sellers. You have the futures contracts, which are locked-in buyers who have to buy. You've got no inventory cushion to absorb the shock because of that 7-year deficit. And you have industrial users who can't just wait around. They need the silver now. It really does look like a potential perfect storm. And that leaves us with this final, really provocative thought. The theory presents this scenario less as speculation and more like a math problem. You have a known amount of demand that is scheduled to hit a market with a near zero level of supply. The only question left is, what happens next? Thanks for watching.